We're going to talk now about what that means for the broader recovery. Our next guest, labor economist David Blanchflower, is a former member of the Bank of England's Monetary Policy Committee. He's right now professor of economics at Dartmouth. He joins us from Hanover, New Hampshire. Good morning to you, Professor.
Hello.
You are so well known for your work on labor economics and on wages. I mean, tell me, if we don't see this extension of jobless benefits in the U.S. to the tune of $34 billion, what does that mean?
Well, one of the things we traditionally think in a recession is that you extend benefits because people can't get a job because there aren't any jobs out there. The worry is if you do this, and it looks like it's a political reason not to do it, what it does is it pulls money out, pulls demand out of the economy at a time when recovery is fragile, consumer confidence is dipping. The Fed this week said that they were looking at doing further stimulus. The benefit of a measure like this, where you extend benefits, is these people spend it and spend it quickly. So the economics are extending benefits is good for the recovery, it's good for growth. I mean, it's become a political kind of hot potato now, but in economic terms, this gets the stimulus going again. In a sense, even if the Fed was to start to do the stimulus it's talked about, it won't be as fast acting as this measure, which looks like wise economics, but is complicated politics.
Now, when you were talking about the Fed and their approach to stimulus, Fed Chairman Ben Bernanke is going to be testifying before Congress this week. There are some saying that the Fed's out of ammunition when it comes to keeping the recovery going here. Is this, on the political side of things, extension of jobless benefits, perhaps the next round of ammunition?
Well, it's one of the pieces of ammunition. I mean, increasing spending is one bit of ammunition. Cutting taxes is actually another, but they're not out of ammunition. If you read the minutes, it says they need to be thinking about further stimulus. What they mean by that is further quantitative easing, further pumping of money into the economy. Normally what they'd mean would be interest rates are going to fall. They said actually what it means is interest rates are going to remain really, really low for a very long time, but still that may not be enough. So I take the statement to mean waiting, watching, ready, especially if there's no extension of benefits on the fiscal front. They're going to have to act on the money front.